Hey traders and investors, it's Serge Berger here. What I would like to talk about today is a very high probability pattern on the charts that I think everyone should be aware of. The pattern I'm talking about is called a so-called morning star pattern. It's based around the analysis of candlesticks and through that lens also takes into consideration momentum and investor psychology, investor capitulation. So, if we look at the past 3 days of trading, and it's extremely important to understand that the current market is still very much subject to headline risk from the Russia-Ukraine situation, and also coming up this Wednesday, we'll have the FOMC meeting, so that's also going to be very important to understand. So, those things in mind, we need to take technical analysis with a little bit more of a grain of salt. But given the fact that I've seen these Morningstar patterns pop up on a lot of charts over the past few days, I did want to highlight them. The Morningstar pattern essentially is a down day, which in this case would have been last Thursday, followed by an unchanged day, which was last Friday, and then followed by a rally the next day. Ideally, this is the S&P 500 chart. Ideally, you have this happen obviously in sequence, but also ideally you have a gap between the down day and the unchanged day, and then another gap between the down day or the unchanged day and the gap up. And the S&P 500 has done this. Hasn't done it in as nice a fashion as it could have, but it has done it in a decent way. I can show you a couple of better charts. This is actually coming over from some of the German markets, and you can see here what we're looking at is a stock called Infineon, and actually I think a lot of people should also be aware of it in the U.S. markets. And you can see basically the stock has done exactly what I just showed you on the S&P 500, except that it's done it even a little bit better. You can see a down day, an unchanged day here with a gap down, and then a gap up yesterday morning, and the stock moved higher. A lot of times, what this means is through a psychological lens is that investors basically, after the sell-off day last Thursday, sold off again, but it really just bears got a little bit tired. Then the very next day, in this case Monday, the bulls came in, bears capitulated right away, and the within basically a matter of 2 days, all of the gains or the losses from last Thursday have been recaptured. That is a bullish way of, or that is a way of gauging investor capitulation. Now, again, we have to understand the backdrop, the current backdrop of geopolitical risk, and the FOMC on Wednesday. Would dictate, at least for me, that I'd like to see another follow-through buying day past Monday's highs. So if you look at the S&P 500, certainly past Monday's highs, maybe even past last Thursday's highs. So for now, this is a pattern to watch. It does set up very high probability trades, but even more important than that is that investors looking to buy a stock based on this kind of pattern, what they really have is very defined risk at, in this case, the lows down here, which was last Friday's lows. That is, if the stock goes below there, it certainly is time to get out. Just like in the S&P 500, if the S&P were to drop back below last Friday's lows near 1840, it can certainly drop another 20 to 40 handles very quickly. I hope this will make sense. As always, if you got any questions, please tweet me at my Twitter handle, which is SteadyTrader. Good luck out there and take care.